Welcome to Founders and Fortunes, where we dive into emerging founders, family offices, and the deal flow shaping private markets. Today, I'm joined by Ron Diamond, founder and chairman of Diamond Wealth, leading a syndicate of over 100 family offices investing across private equity, real estate, venture capital, and more. Ron is also the CEO of Family Office World Media, a TEDx speaker, and the chairman behind the Family Office Initiative at the University of Chicago Booth School of Business. In this episode, we cut through the noise. Ron breaks down why family offices are at a tipping point, how they're reshaping private equity and VC, and why most still don't have a playbook. We get into governance, long-term investing, and the power of patient capital, plus the mindset shifts needed to sustain wealth across generations. If you want to understand where real capital is moving and how the wealthiest investors think, this episode is for you. Well, we've had the pleasure of featuring Ron previously in our Family Office Growth newsletter. Today, we'll dive deeper into unexplored territory and gain fresh perspectives from Ron's extensive experience. Ron, thanks for joining us.
Great to be here. Thank you. Thank you for having me.
Yeah, my goal today is to kind of dig a little bit deeper, as we discussed, into a lot of the thought leadership and key opinion leadership that you've been providing to the community, the family office space. And Ron, you've been instrumental in building communities within the family offices, from Tiger 21 to the professional network and personal network you built in Chicago, where you live. What's the biggest mistake that you've observed family offices make when building their own internal cultures?
Well, they have no playbook, right? So, and they don't start with that. They typically, somebody has a liquidity event and they start a family office, and the first thing they do is start investing. And that's not the first thing they should do. The first thing they should do is talk to an estate planning attorney, because that's sort of like the foundation of a house. Mm-hmm. After they get that done, they should deal with governance, get a mission statement, and then investing is like the fourth or fifth thing they should do. So they have it kind of backwards. There's no playbook. We're trying to change that, but currently there's no playbook for family office.
And I understand, and that's a great point. There are some books that have been out there. Richard Wilson authored one a couple of years ago, and more recently there have been some from more of the education side of things. If you were to put a playbook, and I know you kind of laid get the real estate attorney, the estate planning attorney set up. Investing is like stage 3, 4. It's not from the jump. What are some of the things that you've done? Can you build on that a little bit more in terms of the culture? How do you let people in your inner circle outside of the family? I know you lean on Tiger 21. Can you build a little bit more on that?
Well, what we do, I put together a syndicate of 100 family offices. So these are families that are anywhere between 250 million to 30 billion. And we just invest together in the private markets, like private equity, venture capital, real estate, and credit. And because we can place a lot of money, we're typically able to get better economics. So that means we might be part of the GP, we might be able to get reduced fees, et cetera. We don't charge anything, but I'm doing it because it gets me access to better deal flow. Because I could place $50 to $100 million per deal if I aggregate everything. If I don't, I can't. So that's really why I do it. And the interesting thing is, the term family office is bantered around so often, and 68% of the family offices that exist really started since 2000, and half started since 2008. So it's a new industry. And I've said, thousands of times, the model doesn't work. 25% make it to the second gen, 10 make it to the third, and 5 make it to the fourth. It's fragmented, it's inefficient and siloed. 85, 90% of the family offices that exist, in my opinion, shouldn't exist. It's certainly the way they do exist. So you've got a huge amount of money. It's a new industry, huge amount of money, fragmented, siloed, inefficient. Model doesn't work. We need to change that. And that's really what I'm trying to help, because I look at this as an inflection point that as private equity and venture capital disrupted the public markets in the mid to late 80s. There's a better model. I believe family offices are not going to replace, but are going to start to disrupt private equity and venture capital, because they've got something called patient capital, and we could touch on that later.
Yeah, absolutely. So, and that's a great point, talking about private equity and the disruption that had in the 80s. And I remember on one of our more recent pieces, we were talking about LBOs and how your father, wrote a book on LBOs back in the day in the 80s. Would you consider writing a book on family offices and advising them, maybe putting together a blueprint that you're touching on now? I feel like you have a good, thumb on the pulse of this stuff.
Yeah, I'm thinking about it. My dad was interesting. My dad wrote a book called Leverage Buyouts. It was written in 1985. I was a sophomore at Northwestern University. I had no idea what leverage buyouts were. And what was interesting is at the time, I had just been offered a job at Drexel Burnham, which at the time was the most profitable firm on Wall Street. This was with Michael Milken and junk bonds, and it was extraordinarily profitable. So I took the job with Drexel, and my dad said, there's an industry my dad was a banker, very brilliant, very successful banker. And he said, there's a guy who works at the bank with me who's starting to do some interesting things with me, and it's called leverage buyouts. And, when you're 22 years old, you don't really listen as much as you probably should to your parents. So I said, Dad, I'm good. I got a job at Drexel. So 2 years later, Drexel goes bankrupt. The person that I refused to meet with John Canning, who was the founder of Madison Dearborn.
Yeah.
And I learned that leverage buyouts were really the precursor for private equity. So I look at this as that was an inflection point, and that was sort of like, it still turned out fine for me, but I look at that as an inflection point, and I look at that where we are today is that family offices are really going to start to disrupt private equity and venture capital, because a lot of the model, I ran a hedge fund, and if I'm running a hedge fund and you're running a company, it's hard to run a company and have to report to somebody every 90 days, because then you're kind of managing your earnings. So it's not really efficient. So private equity and venture capital exploded because it became a multi-trillion-dollar, super profitable industry, because at the end of the day, you don't have to report to somebody every 90 days. In the model, 2% covers the overhead, 20%, I make money if you make money, but align, interest for better align. So the industry took off. What's happened in general, and I speak about this a lot, and there's several issues. One, in general, and I'm generalizing, many of the private equity firms have become an AUM game, and they're making their money in the 2%. So if you do the math, if you could raise a $5 billion fund and you're getting 2% annuity every single year, irrespective of how you do, it changes the dynamics of what you're going to invest in, because now you're probably you have more capital than you probably need. And then you're investing in other companies, and sometimes you're overpaying for companies. The other thing I think with private equity that I think they needs to change is, when it first came out, it was financial engineering, right? I mean, and it worked. I could leverage a company and, take out a bunch of debt and strip the company and make a profit on it short term. It's not necessarily going to be in the best interest, medium and long term. And I think in order for these companies to really be efficient, you need to operate. And if you look at the private equity people, I'm a finance person, but if you look at them, 80, 90% of the people are finance guys. Very few are operators. In order to create true alpha in private equity or venture, you need to operate, not financial engineer. And that's something that's going to change.
And that's one of the theses, or the primary thesis of Arondight and the work that I do, is networking really with, secondaries, alternatives, finding founders that are at the Series A, B, C, pre-IPO inflection point, and then making introductions to family offices and giving families really great deal flow. I vet them. I do the due diligence. In my experience dealing with hundreds of family offices and making these introductions, I feel like sometimes it's a 50-50. Sometimes I think you're more of the rare side, where you come from the finance world, but you understand the importance of being, a partner when you become an investor instead of a financial engineer. I very much agree with that point. You've taught me a lot of what you just said in deep. Direct investing is something that I think a lot, it's either a family is incredible with it, or they're just starting out, still testing the waters. They had some wins and then losses after COVID. What are your thoughts on direct investing, on becoming an operational partner for a startup late stage?
If you have the bench strength and the bandwidth, it is a superior model. Having said that, very few families have the bench strength and the bandwidth. So most family offices should not be doing direct investments. What happened was post-crash, pre-COVID, I don't care what you invested in, private equity, venture capital, real estate, Bitcoin, the stock market, everything went up. And a lot of the family offices who had a liquidity event, they said, why should I pay an expert in real estate or in private equity or venture capital 2 and 20 if I can go direct and make money and pay nothing? And they were right until they were wrong. And then about 3 years ago, when they started jacking up interest rates, a lot of family offices not only started not making money, they started losing money. Carter did a study, the average Series B was down 50%, the average Series B was down 75%. So now you started seeing that, and they're way over their skis. A lot of these family offices also did direct deals in real estate, and rather than going through a fund who are experts on this, they did it themselves. And now they're going to have to refinance, and they're going to have to give it back to the bank, or they're in way over their skis. So I think that what happened was people are very myopic, and they think that, they want shortcuts, and they want to figure out ways where they can make as much money as possible, which is good. But you can't take shortcuts in investments. And I ran a hedge fund. I was fairly good at that. I'm not good at a lot of things. And so I just try to surround myself with people that are smarter than me in various areas, in venture and private equity and real estate and things like that. So I think that it also, ego really was a big driver too, because a lot of, people had a large liquidity event. You sell your company for $500 million.
You can't lose.
Right. But, you're good at something. You're not good at everything. And I always use as an example, Ty Warner was a brilliant businessman. He created Beanie Babies, sold it for billions of dollars. And then he figured he could buy the Four Seasons Hotel, and that was a debacle. So that's just one example of it. But I think you've got huge amounts of money in inefficient hands, driven primarily by ego. And I think the family offices in general are in over their heads. Having said that, the ones that aren't in over their heads, the Pritzkers, the Crowns, the Gates, the Ballmers, et cetera, they've institutionalized it, and they can compete directly with Blackstone and Carlyle. And to me, it's a better model because they've got something called patient capital. So if you look at how the private equity model works today, private equity firm buys a garage door company in Des Moines, Iowa. When they buy it, I could tell you within a year when they're going to sell it because I know how they're compensated. They're going to probably sell it in about 5 years. It doesn't make them bad people. It's just, that's the compensation.
It's business. Mm-hmm.
So then who are they going to sell it to? They might sell it to a strategic, but often it's to a second private equity firm. So they'll sell it to a second private equity firm. They'll hold it for, I could tell you, 4, 5, 6 years, and they'll sell it again. So over the course of 20 years, you could see this one company change hands, let's call it 4 times. If you look at the taxes and the friction and the inefficiency and the disruption in business versus a family office by doing it, selling 4 times, versus a family office who could simply buy it, let it compound and hold it for 20 years, the results aren't even close. It is objectively a better model. The issue right now is that very few families have the bench strength of the Pritzkers or the Crowns or Dell or Gates or Ballmers, et cetera. So most of them can't do that. I think what's going to happen is you're going to see more and more of these families get that and then compete. And once they have the bench strength, they objectively have a superior model because there's no time clock. There's no, we have to sell in 5 years. If a company's doing great, why not hold it for 10, 20, 30 years? But you can't do that in the way the current private equity model is structured based on how they're compensated. So that's why I think that family offices, again, they're not going to replace ever because there's going to be a huge market always for private equity and venture capital, but they're going to disrupt them. And these firms, I think that the smart private equity, Paul Carbone is a good friend who's done an incredible job with Tony and JB Pritzker's family office. They have a better model, a superior model, and they don't have a shot clock. So I think that's the direction this industry is going to go. The small family offices, I think, are going to morph into the multifamily offices. The large family offices, I think, are going to get bigger and more sophisticated and be able to compete competitively and do a better job than the KKRs, the Blackstones, or the Carlyles of the world.
Yeah, and the longer, as time has continued to go on since I met you 2 years ago, you are starting to see that more. You're starting to see our friend Chris Cecil built more family office, the offering that he has with multifamilies. That is a trend that I'm starting to see emerge. And it's funny, Ron, and I don't know, maybe this is from the perspective of the founders, of maybe the service providers. The idea, I feel like going back 5, 10 years ago was always, oh, single family offices are the way to go. Those are the people we want to deal with. We don't want to deal with the multifamily offices. But maybe it's because the multifamily offices have the infrastructure in place to not let these types of people, slip through the cracks, that they maybe shouldn't be having conversations. Whereas the single families, they're not professional enough. And that trend is starting, to change a bit. And just piggybacking off that point, and you did address this a little bit, if you could redesign the family office model, for lack of a better term, from scratch, what's a key element that you would fundamentally change to help
Well,
other families?
I'm trying to do that with a few other people at University of Chicago Booth. I did it at Stanford, and now we're creating a program at Booth. Look, the first question is there is no playbook, right? You sell your company for $100 million, your widget company for $100 million. That's a ton of money. So people start a family office. Well, it's not enough money to have a family office. So the question is, how much do you need in order to have a family office? In order for it to make economic sense to have a single family office, if you're going to invest in the private markets and have a deal team that's going to be vetting these deals, you probably need $500 million. Now, that right now, there's a lot of family offices that are under $500 million. And I make no judgment on anybody on anything they do. It's just not enough money. Because if you do the math, if you reverse engineer it, rather than paying for your own admin, your own lawyer, your own accountant, your own everything, a multifamily office, really, you're splitting the cost with 5, 10, 20, 50 other families. So the model should be family offices anywhere between 5 or 10 million up to $500 million, I think is going to be better served in the multifamily office area. And the over 500 billion, if you're at $500 million, I'm sorry, or more, I think then you can have a single family office and you've got enough capital. But there's no playbook right now. And that's what we're trying to create at Booth.
So, and great point. And that's why I was happy to plug it at the beginning, because I think it's really exciting what you're doing at Booth and the curriculum side of things. Something that I've noticed, and I get, well, last thing on this point, is the cultural differences between American Western family offices versus more of the dynastic European family offices that go back 150 to 300 years. Whereas in the US, and you've famously talk about the quote, I think it's, the majority of families within 2-3 generations, they evaporate, the wealth evaporates. What are your thoughts? And I really don't know your opinion on this, between the difference where wealth preservation over in Europe, the UK, even smaller still, they're able to preserve it. Is it the cowboy mentality in America? What are your thoughts there, if you have any?
It's a really good question. There's no one specific answer, but I think that, again, a lot of this is driven by ego. And I think that because somebody does something really well and has a liquidity event and sells their company for a lot of money, they think they could do other things equally well. And usually you're pretty good at something and not good at a lot of stuff. At least that's the case with me. So I think the ego gets in the way. I think that a lot of the, we work predominantly, I have a syndicate of about 100 family offices. It's predominantly U.S. family offices. So we don't really work too much with the European family offices, but they look at things through a different lens. They understand that this family business has been in the family for generations, longer than this country exists. And I think they look at things differently. They look at themselves more as stewards of capital. And again, there is no right way, and there is no playbook for it. But I do think that what's driving this, at least in the U.S., is there's no statistics that are actually accurate, in my opinion, but they say there's roughly 15,000 family offices. They say it controls roughly $10 trillion in capital. I think 10 trillion is pretty accurate. 15,000, I have no idea if that's right or wrong. It could be half of that. But so you've got all these family offices, you've got 10 trillion in capital, but you've got 124 trillion that's about to transfer from the baby boomers to the next gen in the next 20 years. So we're about to experience the largest transfer of wealth in history. And as a result of that, these family offices are going to get bigger and bigger and bigger. But you need to create a playbook for it because, again, there's no model. So currently what these family offices do, they have a liquidity event. They start investing with their friends, which is not the first thing they should do. Then they start going to these family office conferences. And I'm friends with a lot of the people who run the conferences, and there are some good conferences, but many of them are just pay to play. So if I'm listening to you speak, you spent 25 grand to speak. You might be really good. You might not. But the reason I'm listening to you is because you spent money to speak. So it's a pay to play model. So I don't think that that's the right model to do it. So what I did, I chaired the Disruptive Technology Center at Stanford. And I said, it was during COVID. I said, let's put together a family office initiative at Stanford. I needed to do it at the university because they don't have their agenda is research and education. So I had to do it with the university. So I said, let's put together a family office initiative at Stanford. And we did that. And I said, let's put together a conference because the investors that invest alongside with me will always say, I see you're keynoting this conference. Should I go? And 9 out of 10 times, I'm like, no, don't. It's not a good use of your time. So I wanted to create a conference that I would go to, or I would tell the families that invest alongside me they should go to. So what we did at Stanford is, I went to Kirkland & Ellis and EY because we do a lot of work with both those firms. Ryan Harris is a brilliant guy who runs the family office practice for Kirkland. Eddie Stover is a brilliant guy who runs the family office practice for EY. I said, look, you guys put the conference together, do the legwork. I'll do 2 things. I will get you world-class speakers, and I'll pick the content. That's it. And I'll give you 3 examples of what we did. The first call I made was to Paul Carbone, who's become a good friend. And Paul was talking, he runs the family for Tony and JB Pritzker, talking about due diligence, sort of like the funnel. It starts at, there's 1,000 companies, then it goes down to 500, then 300, then where does he come in? And then how do they vet deals? He was simply talking about their due diligence process. He wasn't pitching a fund. He wasn't raising any money. So it was pure education. We had Tim Callahan, who was Sam Zell's partner. This is during COVID. He did extraordinarily well in the office market. He wasn't raising fund for offices. He wasn't raising any money. All he was saying, he was opining on what he thought was going to happen to the office market. Because remember, during COVID, we didn't know if people would ever come back to offices. So he was just getting thoughts, right? Purely educational. It turns out he was almost spot on everything he said. But he was just giving his thought leadership on it without an agenda. And then the last example I'll give is Denise Illich. Denise is a good friend, and she runs from Little Caesars, and they have a couple of sports teams. She, along with Dan Gilbert, really helped rebuild Detroit. She wasn't asking people at this conference to donate to her charity to rebuild Detroit. She was just saying, if you're going to be philanthropic, no matter what your cause is, you need to run it more like a business. And here's kind of what we got right. Here's what we did wrong. Here's what we did right. And it was just educational with no agenda. She wasn't subtly trying to have people invest into her philanthropy. We had 880 families from 6 continents on a Zoom call, 420 over $1 billion during COVID. That was sort of like the aha moment when we realized that there's a huge demand for pure content. But to create pure content, how do you do that? Because everyone needs to make money, and these conferences, they need to make money. That's why I felt I had to do it with the university. So I was doing it at Stanford, and then John Doerr donated $1.5 billion for the School of Sustainability at Stanford, and got political. So 3 years, I was having lunch. I started my career at Drexel Burnham, and my first boss was Michael Milken. I was having lunch with Michael Milken and Steve Kaplan, who is the top professor at Booth, and I just said, look, we've got an incredible thing going. It's getting political. I want to take what I've done at Stanford and move it over to Booth. And before I finished the sentence, Steve said, done. So that's kind of what we did. And what we've done at Booth is we basically created a system where we have a course. It's the first classroom that's being taught in the MBA program. So you have to be an MBA student at Booth in order to take the class. And we had Professor Heaton teach it. I taught one of the classes, and there are a couple other families that taught some of the classes. And it did extraordinarily well. We sold out right away. We had 65 students. Semester, we're going to have it was a half a credit. Next semester, we're going to have a full credit. And the my belief is that today the top kids out of Booth or Stanford or Wharton or Kellogg, what do they want to do? They want to get into private equity, sometimes real estate, sometimes venture, sometimes hedge funds. Nobody wants to go into a family office. But I believe that in the next 3, 5, maybe 7 years, that as the wealth gets transferred, 124 trillion gets transferred from the baby boomer to the next gen, I believe the first choice of these students out of these schools will be to work for a family office. Right now, it's not even on the radar. So what we're doing at Booth is we're kind of creating a program, a playbook for it. And right after I announced what we're doing at Booth, MIT reached out, and there's a bunch of other schools that are reaching out that will probably do this, and that's fine. It's going to happen. And I think how this is going to change as an industry is rather than doing these conferences, I think it's going to happen from academia because they don't have an agenda. Their agenda is research and education, and then we can make it pure. And then a family office of a liquidity event can go to a University of Chicago Booth or Kellogg or Wharton or Stanford, and there's a set program, and they know there's no agenda where people don't have ulterior motives to try to sell product. I think that's how it's going to play out. So we're still in the second inning in the evolution of this, and probably the very first inning in the evolution of partnering with universities. But I think this is how it's going to play out in the next 5 to 10 years.
Yeah, and I remember I had the pleasure of joining you at Harvard late last year, and that was with the undergrad students, I believe, and I was blown away working in the space. As you know, most people don't really know what a family office is. Many of them did. Again, it was Harvard. But let's focusing on that and what you've done at Booth and the teaching. Has teaching influenced your views on wealth management or the operations of family offices? What have you learned from this process at Booth?
It certainly, it's reinforced that this is the only way that this is going to work. In my, you go to a firm like Goldman Sachs or, and they're very profitable firms, but all these firms, they've got an agenda. You go to Northern Trust, they have an agenda. They want you to deposit money into their account. They're a wonderful firm, but, they still want to deposit money. The investment banks, they want to do M&A deals, or they want to have you as investment banking clients. The university, what's their agenda? Their agenda is really research and education, and that's it. And so,
maybe endowments, but they get that from legacy.
They do. That is true. But if they're if one of the goals is to maybe have 1 or 2 of these really wealthy people donate money, and name a school after them, that's fine. To me, that's not a conflict.
No.
A conflict is when the only reason you're speaking is because you spent money in order to present.
Yeah.
At Booth, we're putting together, we had the course. We had 65 students. We're going to put together a conference in May. We're going to keep it very small, probably only 150 people. But here we're going to have Nobel Prize winners from University of Chicago talk about geopolitics, talk about what's going on in the macro economy, what's going on in with interest rates, et cetera. And it'll be pure educational, and nobody will be selling anybody anything. So this is what families want to hear, but they don't right now because of the model of these current structures of the way the family office model is built right now with the conferences. I think that's starting to change, and I think Booth will be the first one to change it.
I think so too, and I haven't talked about this with you recently, and looking at the material, you must be working with them a lot because I feel like they have the right idea on this from top to bottom.
They do, but I'm working with a brilliant team. It's not just me. There's a whole bunch of us that are working on it together. But I just think that we're in an inflection point in this industry. And like in the late 80s, when I graduated college in Northwestern in the late 80s, this is just when private equity and venture capital were starting to disrupt the public markets. And that's really where we are now. I think we're at an inflection point, and family offices are starting to disrupt private equity and venture capital, but there's a whole bunch of things we need to get right. Part of it, we have to get right the governance. We have to get the succession, next gen. We have to get the compensation model right. So there's a whole bunch of work we have to do. We're not even close to being there. But I'm telling you that once we have the programs in place, because there's no shot clock with a family office, it is objectively a superior model. There just aren't very many family offices that can execute today. That's going to change.
So And I'm glad to hear you brought that up, specifically succession planning. Let's pivot on that. It's often fraught with complexity, right? You talk about ego a lot, relationships. From your perspective, what's one critical psychological or relational factor that families often overlook when preparing for generational transitions?
Well, there's something called governance. And a lot of family offices, they have a liquidity event and they don't even know what governance, they don't maybe know what it is conceptually, but they don't think about it. And because they want to start investing with their friends who realize it came into a lot of liquidity and their friend's a smart guy, so they're going to put 5 million into their real estate deal or 10 million into their private equity deal. You got to get the governance right. And without the proper governance, again, it's like the foundation of a house. You have to talk to an estate planning attorney before you start investing because you have to get the structure right. You have to get, the mission statement. You have to get what are the values and goals of the family. Some families are looking to basically preserve their wealth, and that'll last for generations. And there's nothing right or wrong with it. It's just their prerogative. Some families they're worth $3 billion. They want to grow it to $10 billion. So they're looking to grow exponentially. Again, you have to figure out where you are. And a lot of these families don't really do a gut check and figure out, okay, here's what I really want to do in the next generation or in 2 generations and 3 generations. This is what I want it to look like. They start running before they walk. And I think that that's a problem with the industry. And I think, one of the things we're trying to do at Booth is to create a playbook in order to do it so that the families just say, okay, I had a liquidity event. What do I do? A, talk to an estate planning attorney. B, deal with governance. C, figure out a succession plan. D, get a mission statement. Then you can start investing and things like that. But we don't have a playbook right now. So what's fascinating to me about my industry is that it's changing in real time. And I see it happening. And I can tell you how it's going to happen. I could be wrong on the time frame, but directionally, I'm absolutely correct. It's just, maybe it doesn't take 3 years, maybe it takes 5 years, maybe it takes 7 years, but it can't not happen because objectively it is a superior model because it's got patient capital.
Couldn't agree with you more. I want to pivot towards you a little bit more. Relationships are always at the forefront. You talk about that a lot, and this is all connected. We talked a little bit about future trends. Speaking to with you specifically, Ron, what's the most impactful introduction you've ever received? How did that influence your trajectory?
Well, I think that this business, it's a great question. And I think this business is really based on relationships. And think about it, if there's $10 trillion in capital, it's not that, and let's just call it 10,000 family offices, whatever that number is. It's not that 10,000 families are really good or really want to manage money. The reason this happened is they stopped trusting Wall Street. And remember, 68% of the families started since 2000, half since 2008. And, they stopped trusting Wall Street because Wall Street has an agenda, justifiably. So this is a relationship business. And when families work with somebody, the first, second, third thing they want to know is, who are you as a person? The fourth thing they want to know is, what do you do? What's your track record? What's your background, et cetera? That's flipped institutionally. The institutions want to know, what's your 1, 3, 5 year track record? What's your biggest drawdown? What are the biggest risks? Then they'll diligence you as a company. This is a relationship business. And what people get wrong is, if they're trying to raise money from families, they're going to come and lead with their great track record, which certainly helps. But that's not really what's going to get the family to invest with them. What's going to get the family to invest with them is a level of trust and a level of comfort. Once they have that, then they're going to look at the track record, which obviously does help. But it's a relationship business, and much more so. And I think people are starting to realize that it's not a 1 or 2 year relationship. This is a 10, 20, 30, 40 year commitment that you're going to be working together. So I think that's the main difference, that families look at things as relationships. And I think a lot of the pensions look more for economics, specifically at numbers.
And I love that point that you made, comparing the family office to the institution and typical institutions that you see in this space. I think it's an interesting catch-22 because a lot of the flaws and the fragmentation that you see in family offices that they suffer for is from a lack of professionalization with hiring, the right type of people, getting compensation structure right, being willing to look as an investment to bring in new, young, fresh faces rather than a cost for the family office. But at the same time, the ones that do it right, do it right. What are some, looking ahead, what lesser known sector or societal issue do you think family offices are uniquely positioned to have a significant impact on?
Well, you touched on something that's really important, which was the compensation. And that's something that we really have, in general, we've got it wrong and we need to get it right. Now, some of the family offices do have it right, but what happens right now is you have a liquidity event, you sell your company for $500 million. You want to hire some really bright people. In general, and again, I'm generalizing, most family offices, if they're going to hire a kid out of Stanford, MBA, or Wharton, or Booth, and they pay them $250,000 a year, most of them look at that as a cost. They're going to cost me $250,000. And they hire a professional and they're paying him $500,000. He's been in the business for 5 years. That cost me $500 million. When Blackstone or Carlyle or KKR hire somebody, I can guarantee you they don't look at that as a cost. They look at it as a potential profit center. So it's nuanced, but until families start realizing that this is not a cost center, it's a potential profit center. And again, it's nuanced, but that's what they have to start doing. And that's what they're not doing a great job of right now. So we have to figure out a way, in order to compete with the Carlyles, the Blackstones, the KKRs of the world, you need the talent. In order to get the talent, you need to pay for the talent. And in order to pay for the talent, you have to compensate these people, and you have to give them things like not just salary, part of the carry, lines of credit, loans, so they can get involved in it. So you really have to think about what's in the best interest, not just for you as a family office, but what's going to attract these really bright students to you over KKR or Apollo. And it is objectively a better model, but you have to get the compensation model right by giving them part of the carry, by giving them lines of credit or loans, forgivable loans or different things like that, or compensation structures. That's the main thing I think that families really don't have right now. Now, there are some that have it spot on. I speak a lot about Tony and JB Pritzker, who, Paul Carbone is a good friend, and he was at Baird. He was doing extremely well. He would never have left Baird. The only reason Tony was able to hire him, it's not just, I'll give you X number of dollars. He said, look, we'll give you X number of dollars, but you'll also participate in part of the carry. You'll be part of the investments, et cetera. And that's what lured him, and they did extraordinarily well. And he's not the only one, but that's just an example. So that's really the model you have to get right. So this is another thing that families have to get right, is a compensation structure. And right now, most of them, they don't have that right.
Totally. And I like that you always use them as the example. And I know you're close with them, but it's true. They are the ones that are competing with the KKRs and the Blackstone. They're doing very well.
And if I own a company and I'm going to sell the company, if I want to just sell the company and make as much money as I can without really concern for what happens down the road, just cash out, I'll almost never sell to a family office, because family offices will never overpay. If I'm looking out long term, 2 generations, 3 generations, I've got a bunch of employees that I want to take care of.
The people.
A family office will probably pay you less money up front for it, right? But medium and long term, they're much better stewards in general. They're much better partners. So if you're looking for something to just flip and make the most money, you'll never go to a family office, because private equity, what happens with private equity is they raise so much money, and they've got 2 options. They could either give the money back, which they've done 0.0% of the time, or they could deploy that money. And in a market that's heated, they sometimes have to overpay for deals. And we've seen that, as family offices, we come in and we're looking to buy a company, and we're close to buying it. And then a private equity firm who's got $20 in dry powder, they're paying 2.5 times what it's worth. And it's insane, but they have to do it because they've got the capital. So I just think it comes back to alignment of interest. And I do think people are going to get educated on it. And again, I think private equity and venture capital will still have a huge growth area going forward. But I think that now the new game in town is going to be the family offices. but we're still very, very early. If we have this podcast in 5 years, I think our conversation is going to be completely different.
I could bet on that. I totally agree. Thank you. And now I will go more because I want to talk a little bit more about you. And we had a great article on entrepreneur.com talking about your background, exploring a little bit more about the experience that you had at Drexel Burnham, your relationship with Milk and how he influenced you. And there were some questions that after rereading that, I put down, I wanted to ask you about your journey specifically. And with the exception of what happened with Drexel, your first career job, was there ever a moment of significant doubt or uncertainty for you, Ron, in your career, and how did you overcome it?
Absolutely. But and I think that look, I didn't consider myself an entrepreneur. I got a job, graduated Northwestern, I got a job at Drexel Burnham, most profitable firm on the street, and my plan was to be there for 40, 50 years and hopefully run or maybe even run the company one day. That was my goal. So I didn't consider myself an entrepreneur. But then when Fred Joseph, who's the CEO of Drexel, comes into a room, and I'm in the room with a bunch of people in their 60s and 70s, and he says, we're going bankrupt. Now, I lost a good job. I didn't have many stock options, so I didn't really lose a lot of money. But I'm watching these people in their 60s and 70s, and in the late 80s, I promise you, men didn't cry on Wall Street. Well, they certainly did there. And I remember vividly the scene. And I remember the woman with big green glasses. I remember somebody with a ridiculously oversized scarf. I remember fragrances. It's because it's been imprinted upon me. And from that, I basically made a decision that I would always be extremely loyal to people, like ridiculously loyal, but I would never, ever, ever, under any circumstances, ever be loyal to a company. Because if this can happen at Drexel, this can happen to any company. So my loyalty lies with people, not with companies. And if you look at what happened, Salomon Brothers, DLJ, Bear Stearns, Lehman Brothers, Kidder People, go down the list. There were some wonderful firms. So what caused me to start my entrepreneurial journey was not that I felt I was an entrepreneur. I just was so disillusioned with what happened. So I came back without knowing what I was doing, starting a hedge fund. I mean, I was in way over my head. I started with a couple $1,000,000 from friends and family. And I was just, I think as most entrepreneurs, when you're in it, you're like a pit bull. You're going to make it work. And I made a ton of mistakes and I had a ton of doubts. And a lot of times you ask yourself, what am I doing? Now, fortunately, it worked out. And fortunately, we had some luck, which I think is true with a lot of entrepreneurs. And a lot of them that don't admit that, probably fooling themselves. In the 90s, it wasn't that hard to make money. We were pretty good stock pickers. And if I took the same strategy and did it in a different decade, we wouldn't have done nearly as well. So I had a combination of, this happened, which forced me to become an entrepreneur. And then we had tailwinds behind us and I was able to grow it and we were able to, we did fairly well. And then based on that, I was able to put together a syndicate of families and start investing. But it was, any entrepreneur who says they didn't have self-doubt, I have a lot of confidence in myself, but there's certainly days, the problem is it's like you have no net, right?
Right.
Work for a company, you have there's a bad quarter. It's not like you have to worry about payroll. I mean, you might not get a big bonus, but here you're worrying about other people's lives. So it's a different animal and it was not something I intended to do, but it was something I was thrown into based on an experience that I had, based on being disillusioned about what Drexel did and how the way in which they did it.
And great answer. And when we last spoke about this and your upbringing and the relationship you had with your father and the LBOs, and he was ahead of his time in that space, what was his advice to you after Drexel? And when you went to this direction, was he supportive? Was he like worried? What was that like?
No, my dad,
was a banker by the bank. You come from a family of bankers,
right? And my dad was brilliant, but he's also a mensch. He was a wonderful
sweet guy.
He's a wonderful human being, and he would support me whatever I did. And he's like, this sucks that Drexel went under, but I think he had enough confidence in me to know. He goes, you'll figure it out, and I felt that confidence, and that gave me more confidence. So I was fortunate because some people were born on second base or third base because they have a lot of money. I didn't have that, but I had an incredible family. I had two brothers and a mom and a dad where there is consistent love and support. And that to me is light years ahead of where most people are. So I was born on home plate, really not from a financial standpoint because I didn't have money, but from a standpoint of support, education, love, and they emphasized the importance of education. So I just realized as I got older that not everybody had that. So I feel very, very fortunate how I was raised, and I owe a lot of that to my mom and dad and two brothers.
Yeah, and in some ways, like you could even say that love and support is more valuable than, being born on third base with all that wealth where people will struggle down the line.
We see it.
I love that.
I see a lot. I mean, when I was in high school, the trust fund kids, which I was certainly not, um, two of them are dead. One from overdose. One just couldn't get his act together. Um, One is thriving, but he came from a family where he wasn't entitled. He had a lot of gratitude. But it's a challenge because you do quite well, and then how do you raise children? How do you raise kids that are great, have gratitude, and don't feel entitled? And that's parenting, and there's no playbook for that. So I think a lot of how I look at things transcend money. It has to do with how you're raised and the way you live your life. Because I don't care who you are, there's no career goes from here to here. It goes like this and like this.
Yeah, it's up and down.
And others. But what happens. So you're doing great, and then what happens when you're down here? How do you react? And that's really the difference between the successful entrepreneurs and the non-successful ones. When you're up here, yeah, it's great to give yourself a high five, and everyone. It's not hard to be high on what you're doing. But when you come down here, the difference between the people who succeed and don't, in my opinion, are how do you handle that? Because that's going to happen. It can't not happen. I've never heard of a company or an individual who's just gone from A to Z. And you could look at even the biggest companies like Amazon or Microsoft or Apple. They all had hiccups as well. And I think that it's how you handle, how you get yourself up from the setbacks that really determine how you're going to do. Because everybody's going to have setbacks, and I certainly have many.
Absolutely. And sticking on that theme, there are a lot of, and particularly on the wealth transfer, there's a lot of young stewards of family offices that are coming into their own now, that they're passing the torch. Gen X obviously is really the next in line, but I find myself connecting with a lot of family office principals who are my age, early 30s, and some even younger. What piece of wisdom would you offer to these young people that are coming in to their own with all this responsibility relatively early on in their career?
You have two ears and you've got one mouth. Listen, don't talk so much. And that's what I would do. I mean, I try to.
That's great advice.
I always try to surround myself with people that are smarter than me, that are older than me, that they've got some wisdom, they've made mistakes. Just listen, and you could see what people do. And I think that's one of the things your generation is not great at. Mine isn't great at it either. But I think in order to really get to the next level, you really have to listen. And when we're having a conversation, you're listening, but a lot of times people listen and they're ready to say what they're going to say before they fully listen to everything that's said. So I think that the advice that I would have is listen, watch, and observe rather than talk so much. And you'll learn. And you'll learn what people do right, and you'll learn what people do wrong. And you'll learn this is the type of family that I want to raise, and this is not the type of family that I want to raise. This is the type of family office culture I want to have, and this is not the type of family office culture. And the only way you could do that is by listening with the ears and not talking so much.
I love that. That's an excellent answer, Ron. I have two more questions for you. First, when all is said and done, what do you hope will be the most lasting contribution of your work to the family office community?
100% philanthropy. So I think that I don't think that family offices are going to, it's not a panacea. They're not going to solve all the world's problems, but I'll give you a couple examples. My dad passed from prostate cancer. He was 57. He got it when he was 52. And back then, if you had prostate cancer, it was not good. The exact same. So my dad went to 2, 3, 4 doctors, got second, third, fourth opinions, and he lived for 4 years and he passed. What Michael Milken did is he also developed prostate cancer, and he was my first boss. So I was close with him. Rather than just going to 2 to 3, 4 doctors, which he did, he built it like a venture capital firm. He basically put 250,000 here, 3 million here, 5 million here. And because of Michael Milken, you, I, and the male listeners of your podcast will probably die with, but not of, prostate cancer if we live long enough. You look at what Bill Gates, irrespective of what you think of Bill Gates, I would argue he did more for the cure of COVID than the U.S. government. Eric Lefkowski, he was a founder of Groupon. His wife developed breast cancer. He wanted to help his wife because he loves his wife. As a result of that, he ended up starting a company called Tempest, which is now a multi-billion-dollar company, publicly traded. But so these are just examples. So I don't think you can run a philanthropy exactly like a business. But my North Star is that I do think that family offices, with the amount of wealth they have, and everybody's been touched by something, by autism, by cancer, by diabetes, it doesn't matter what it is. If they're passionate about the cause and they figure out a way to be philanthropic and run it more like a business. So my North Star, to answer your question, is to make it have a significant impact from a philanthropic standpoint to basically change some of these real world problems. And I don't think it's going to come from the corporation. I don't think it's going to come from the government. I think that's going to be the real lasting thing with families, not that I invested in better private equity deals than you did.
Thank you, Ron. And last question for you is, if you could host a roundtable discussion with any 3 thought leaders, past, present, alive, dead, who would you invite, and what central question or conversation would you like to have with them?
Probably bring in Aristotle for sure. Bring in Plato. I'd bring in some philosophers.
There you go.
I'd bring in Buffett because I've just been a huge fan of his. I'd bring in a team. It wouldn't just be all finance guys, but it would be a team. I'd bring in some psychologists. I maybe bring in Freud. Because I don't think this is just. It's not just about finding the best deals. It's really living the best life. And so if you're asking me who I would have on my roundtable, it would be those people. It wouldn't necessarily be 10 of the top financiers. That's probably true with a lot of people. To me, it would be much, much deeper.
With Freud, it would be a party. So
I know where all my issues came from. Yes.
That's good. That's a good one too. Ron, it's always a pleasure to have you. Thanks for joining me. And before we wrap up, how can our listeners best follow you, your ongoing work? Where would you like them to connect?
I have my social platform is familyofficeworldmedia.com. And so I put out a lot of content, and then I'm fairly active on LinkedIn. So those are probably the 2 best places to do it. And then we'll be putting out more stuff that we're doing at Booth. So we'll be publishing more things as well. But that's probably the best way to reach out to me.
Excellent. Thanks, Ron. I really appreciate you joining me today. And this was a great discussion. I hope you enjoyed it. And we'll speak again soon. Have a great rest of your week.
Okay. Thanks for having me, Ryan.
Thank you. Bye.
Bye-bye.
If this episode gave you insight, hit subscribe and drop a review. It helps more people tap into these conversations. To dive deeper into family offices and private markets, follow Ron Diamond on LinkedIn and check out Family Office World Media Podcast. If you want to stay ahead on deal flow, investor strategies, and the future of private markets, connect with me on LinkedIn and subscribe here on YouTube. Thanks for tuning in to Founders and Fortunes. Catch you next time.